So hi, welcome to the Seattle Angel Conference Workshop Series. Today we have Luni Libs of Fledge Impact Accelerator fame, who's going to talk a little bit about emerging markets and how investing in them might not be as scary as people think. And I'm John Seacrest, and I'm trying to make ecosystems go faster. I do the open coffees every Tuesday. I do the Lean Startup Seattle. I run the Seattle Angel Conference, and we've now tried some experiments with a health-focused one that finished in March, and we'll start again in February. And then we're doing a transatlantic angel conference where the final event will be July 7th. And so we're experimenting with expanding outside the Seattle area with this model. We also run a fund manager peer learning group for people who want to gather capacity to professionalize their angel investing. Nonetheless, we're seeing a lot more interesting international investment opportunities now that COVID has taught us how to use Zoom. And so we'll talk with Luni here a little bit about his Fledge habit of engaging African companies and how that's brought him into a much broader perspective about investing. So Luni, take it away.
Thanks, John. In this talk, I started with a slide deck that came from the Angel Accelerator, the first cohort, the one Jonathan was in, and then I added to it. But I'm just throwing that brand on here. John, you inspired the Angel Accelerator to exist. We've done 4 of those, and we did some transatlantic work on one of those cohorts. We had someone from London, we had a bunch of people from the US, and it was focused on Africa. We didn't get any Africans in that one, but we'll do it again. So again, the topic is investing globally, and the subtitle is not as scary as you think. Before we dive in, this is me in a nutshell. I've been an entrepreneur now for 30 years, first 20 years in tech, everything in Seattle. So 5 software companies in Seattle. I started 4 of them. 4 of them were backed by California VCs. I learned how to do early stage investing by being the entrepreneur. And then in 2011, discovered this very strange business school called Bainbridge Graduate Institute. Unfortunately, it's no longer around, but it was the first business school, accredited business school, to teach how to do good through business, sustainable business, impact business. We didn't have the words for it back then. Taught there until it closed down in 2019. That inspired me to do Fledge. I'll explain what that is. Everything else I do has spun off of Fledge. That includes a nonprofit, includes the Angel Accelerator. So this is what Fledge looks like now. It was a little program in Seattle. I think I'll get to that in a few slides. It is now a global network of business accelerators, all focused on impactful businesses, not tech businesses, not the Techstar model, but kind of similar to the Techstar model. So we find companies from all over the world. We give them a little bit of money. We give them a lot of help. We set them free, and they tend to succeed more than they fail. And we're going to talk about Africa mostly today, but we have investments in South America. We have investments in Europe. We had the first ever investment in a company from the country of Georgia. One in India that didn't work out. One in China that's chugging along, but not dead yet. One in the Philippines. Since the pandemic, my focus has been primarily on Africa because we happened to have collected a whole lot of African companies along the years, and almost all of them were in the food and ag space. And I was worried when the pandemic hit that we would see a lot more starvation in Africa. And luckily, for no known reason, it didn't happen. But nonetheless, we have a whole bunch of companies there, and they're doing great. And I'll tell you about some of them in a bit. So I've been in Seattle for 31 years. It's been my home. I've done all my work here. And in 2012, I sat down to build a business accelerator, and it started in Seattle. But the scope of the work wasn't even national at the time. The scope was barely even the west side of the continent. The scope was basically Seattle for the first cohort. Second cohort, we got all the way to Vancouver. Third cohort, I think we had somebody from outside the region. And then the fourth cohort included half from Africa. And so I had to learn a long time ago. That was 2013, 2014. when I first had this question of how on earth do you invest in a company that's not American? And again, it's not as hard as you think. But before we go there, I'm going to keep taking these little asides. Hopefully, you know what the Halo report is by now, right? So this is the #1 report for angel investments. And these slides are back from a few years ago. So this is the 2018 Halo report. I have no idea how it's changed since then. But what's interesting in part of this report is where's the investing happening? And back then in that year, 90% of all the investments from the investors in the Northeast stayed in the Northeast, right? So the country split into multiple regions in this report. And here in the Northwest, 92% of the investments in 2018 were made in the Northwest, and that was up from previous years, you can see. And in California, of course, exports capital, so it was only 42% from California. And it turns out New York exports even more capital. It was only 32%. But a lot of that New York money is just going up to the Boston ecosystem or down to the mid-Atlantic east. They put New York in its own thing, just like California. In general, traditionally, 80% of investing has been local, like startup investing. And the trend is for it to get less and less because we have things like AngelList and WeFunder and Start Engine now. So now you can see deal flow all over the place and whatnot. But traditionally, way back when I started, it was even higher than 80%. Like when I started and was trying to get California VCs to invest in Seattle, most of them wouldn't do that. That was too far. Right. Nonetheless, 99% of the entrepreneurs in the world are not here. So, you know, for those of us in Seattle, we're a tiny little city in a very large country, and most entrepreneurs are not here. And only 5% of the population of the world is American. And the actual percentage of entrepreneurs is lower in the US than other countries. Most entrepreneurs are not here. So if you're not investing out there, you are missing most of what's happening. Right? That's the simple truth. So the question will come, why? Why are investors investing locally? Well, there's, I think, 6 reasons on here. Right. So #1 reason, nice and simple. If you're back in the before times, you would find deals in person at events. And so it's very hard to do that and find the deals in London or find the deals in Berlin or find the deals in Tbilisi if you're not in those cities. Now, well, of course, we've broken that since then. #2 is the incorporation laws and the securities laws and just the legal systems in general, of course, vary by country. So if you're investing here in Seattle into a New York company, use more or less the same rules. You're probably investing in a Delaware company either way. You might be investing across the border in Canada and think that's risky because the rules are different over there. But the rules tend to be, even more different in other places. #3, we got risks. So again, before times, we weren't used to being on Zoom, right? And even in today's day, we have time zone issues. And then there's other risks, like if you are going to start a lawsuit, where are you going to do the lawsuit? And we're going to talk about Africa. So we'll talk about political risk, minor currencies, and all the Forex risks. The Malawi kwacha just devalued by 25% on June 1st. Now we're investing because we want money back more than we put in. The traditional way of doing that is through exits. Are there any exits? We'll talk about that in a bit. And then #5 is the key one that's just not spoken about. And it's the system that's been used for decades to get new angels to be angels, which is basically an apprenticeship model. So John's broken that a bit. He's made it a group apprenticeship model. But you're still being taught how to be an angel by other angels, as opposed to, picking up a book and picking it up yourself and going off in your own direction. So the typical way you learn how to be an angel is to drop into an angel group. And if the people in the angel group have been investing locally, because that's what the group's been doing for the last decade, well, then you're going to learn how to invest locally. And that's where your deal flow is coming from and onward. So this is just the momentum of the industry, right? That because the history is local investing, then you get local investing until we have enough enough transatlantics and transpacifics and angel groups that are specifically targeting like Africa, but based with American investors, or India or Southeast Asia or Latin America or wherever. We're just going to see this continued slow progress out of local investing as opposed to a big change. Okay, so back to this map. There are the orange countries are the ones we did investments in. Yellow is where we saw applicants. So basically every country has applied with rare exception. And I don't remember how many orange countries there are on this map. It's 30-ish, 27, 29, 32, something like that. It's definitely more than one, right? And literally that's me signing paperwork into all these countries. I have no fear of that anymore. So why is that possible now? So to go back through those same things again, deal flow. Well, entrepreneurs are everywhere. If you hang up a shingle as an accelerator, which is what I started doing 10 years ago, 2012. If you hang up your shingle as an accelerator, you get applicants from all over the place. So deal flow is not a problem. If you take the effort to go do it, or if you align yourself with an accelerator, or if you just hang up your shingle as an angel group saying, we invest everywhere, they will come. It will be true, and they come more and more every year, as I keep seeing. There is no sign of saturation in the market of anybody supporting a sufficient number of entrepreneurs. Now, in terms of legal, what have I learned in 10 years of doing this in legal side? Yeah, almost all my investments are in countries that had in the past been claimed by the British Empire. So the British Empire was very big. And the good news of the British Empire, there's a lot of bad things that happened, but the good news is they left common law everywhere they left. And common law, it just looks like what you're used to. So I run a company. Africa Eats is domiciled in the island of Mauritius, which is home of the dodo bird, or was home of the dodo bird. It was originally colonized by the Netherlands. It was then taken over by France, and then it was taken over by England. So it has lots of different roots, but the last colonial power was England. It became a free country, independent country in 63 or 64, I think. And they literally, when they decided how to do their securities law, they just assigned that job to some of their clerks in their government. I can clearly see that those clerks were educated probably in London at one of the business schools there. And they just sat down and wrote out what they thought was the minimum set of laws needed to run companies. It's called the Companies Act of 1982, something like that. It's pretty new. It's like 110 pages long, double spaced. It's lovely. It's a lovely piece of law, as opposed to trying to slog through the hundreds of pages of 200-year-old law in Delaware, or the equivalent here in Washington State. It's just so much simpler, right? Here's the rule. You got a company, you have to have this number of directors, and you have to report here and there. And it was totally readable, and it took like a half an hour to skim through. And when we did the actual incorporation, and I was looking through the specific details as the subsections were being referenced, everything was crystal clear. It was actually much easier to deal with that law than to deal with the U.S. law. And same thing when I read the securities laws in Nigeria or Tanzania or elsewhere. And I haven't done this in every country I invested in, but spot check shows that they're all about the same. Then on top of that, because I'm investing as a professional investor with a fund, I have a little more heft than you do as an angel. But it does mean that I'm sending them my agreements to sign, and my agreements are in U.S. law. So sometimes I'll take out the wording about accreditation and whatnot because it's irrelevant. But it's a U.S. contract. So if I'm doing a loan, it's a U.S. loan agreement, and it says it's bound by the laws of Washington State. It depends on which org I'm using, whether it's Washington or Delaware, but it's bound by the laws of Washington or Delaware. And it says if there's any disagreement, we're going to settle it up in Washington courts. or the Delaware courts. And when I do this from my Africa Eats organization, which is domiciled in Mauritius, all the agreements are under Mauritius law, which I just explained is even cleaner than the US law. And it says if we have any disputes, we're going to settle them up in Mauritius. And they have they're top 20 free countries in the world. It's considered part of Africa. It's off the coast. But in terms of freedom and the freedom index and all that stuff, Mauritius is one of those countries like Singapore. It's supposed to be a great place to be. I've never been. I always find it strange. I run a company in a country I've never actually visited. Right? But then again, I haven't been to Delaware since like the 70s. And I run a company that's based in Delaware too. Oh, and there are some chats. We can break in if we want, but we'll have plenty of time at the end for conversation here.
Do you have a bank account in Mauritius?
3.
Which you opened remotely?
Yeah.
Very interesting.
Mauritius is one of these, it has a little offshore taint to it, but it is the Delaware of Africa. And so if you have a Pan-African company, the place to go incorporate that is in Mauritius. And since the 80s, they've been a banking center. And so the banks are all set up to do online transactions. So your incorporator, you'd have to hire a local incorporator. They physically go and set up the bank account for you. And it's an island, so the process is slow. But then you have a bank account. It's in dollars. Everything we do is in dollars. We get charged in dollars. I've never seen a Mauritius rupee. I don't know what they look like. When I log in, it tells me how much my account is worth in rupees, but I have to do an exchange to get there. Everything we do is in dollars. And that online system is better than half of the online systems in the US. And we have 3 accounts because the first bank is charging us an arm and a leg for wires. So we tried another one, and their online system wasn't better. And then we heard a third one was best. So we set up a third one. So we're in the process of shopping between the banks. Okay, so back to risks. Okay, well, yes, there are different risks when you invest overseas. So you might see in the news, just keep in mind that when you're reading about the news of the world, it's going to be the negative news of the world because that's what the news organizations do. Right? You're not going to hear very much positive news coming out of Africa or Southeast Asia or whatnot. So when you hear about the news from Africa, you're probably going to hear about the wars, that there was still fighting going on in the Democratic Republic of Congo, which is not democratic. Yeah, don't invest there. You're going to hear that there is no government in Somalia. Okay, don't invest there. I just did a loan to the country of Sudan that doesn't have a formal government. I did that through my nonprofit because I would never take that risk with my for-profit. But it's an exporter and they have an account, their bank account's in London and they're exporting a global good. So they get money in London. So we said, sure, let's try it. I double checked, got permission from the funder for that one. So I skip countries that don't have real governments, mostly. I skip any place that seems unstable. And that still gives me plenty of opportunities and plenty of places to go, in Africa or elsewhere. The way I further mitigate these risks is just diversity. So yeah, it may be that that there's trouble with the next election in, you name a country, but I don't have all my eggs in that one basket in that one country. I'm diversified across 10 countries in Africa at the moment. And diversity is what's going to lower your risk. Just in general, diversity across different sectors or subsectors, diversity across geographies, as much diversity as you can get is going to help you increase your the returns from your portfolio. And then the other one is just how often you get to talk to these entrepreneurs. That's probably the biggest risk there is the communication barrier and the distance. But you have that same problem if you're investing in Florida or Georgia or Mississippi from Seattle, because they're far away too, right? Or London or Berlin. It doesn't really matter. If you're not investing locally in your same city where you can drive over and tap the entrepreneur on the shoulder, yeah, you have that same communication issue. Okay, biggest one out there in terms of risks is and issues is the rewards, because there are very, very few exits outside of the US. And when I used to get these delegations from the State Department. They'd show up in Seattle, and they would always ask, like, how do we get our ecosystem? How do we get our country's entrepreneurship ecosystem to look like yours in the U.S.? And my answer was always, you've been misinformed. There's only a handful of working ecosystems in the U.S. Right? Seattle happens to be one of them, but we don't even have enough money for our own ecosystem. We import it from California. As we just saw, New York has plenty of money. They're exporting their money. It works there, it works in San Francisco. It doesn't work in Chicago, not to my knowledge. There aren't enough exits to power the Chicago VCs. They must be investing elsewhere, or the Dallas VCs or the Atlanta VCs. It doesn't actually work in most US countries, most US cities. So why on earth would you, if it doesn't work in Chicago, why do you think it's going to work in Democratic Republic of Congo? And so you have to use an alternative structure. Basically, it boils down to, you should probably be using them anyway, but there's just an even bigger incentive to go do something different. And it might just be that you do loans and take a lower return, but there are the revenue-based structures and some other alternative structures you can use. Okay, and then that, in terms of that inertia, well, we just need to do things like this to break the inertia. That's as simple as it is. One way to do that is, again, I've been running an accelerator program, or helping others run accelerator programs as well, for a decade. And what I have learned is that the accelerator model is just vastly superior to the angel model. Yeah, so I've been touting this when I can. So give me 5 minutes on this. Here's the difference. One, in the accelerator model, it's just by definition a fund. So you have a pool of capital, which just adds to your diversity and just makes everything work out better. Second, you hang up the shingle that says you're an accelerator, you will get applications from everywhere. Even if you say I'm an accelerator looking for X in Seattle, you will still get applications from other places. But I don't do that. Fledge in Seattle just says, hey, we have a program, if you want help, come. We do say we're impactful, not tech. But other than that, we just say come. We had 845 applications for the 2020 program. I didn't do one in 2021. We had 1,400 applications for the latest one in Africa. The numbers just keep getting bigger. We get this one. Oh, sorry. And so they're supposed to be opposite each other. So we get this pool of capital, and we can do whatever size investments we want. We still do the $20,000 Techstar stipend at Fledge. I hear you can't do that in tech anymore, but in impact you can. Versus in an angel, you're supposed to be writing your $25,000 checks, unless you do it John's way as a group. Global deal flow versus, the angel groups don't get 800 applications at a time, and individual angels don't see that at a time. Oh, sorry. In terms of due diligence, we get to pick from a huge collection, and it's really obvious which ones are best on paper. We do a little bit of interviewing and due diligence to make sure we're not making a mistake on that. But then after we write this little check, we get to talk to them as often as we want. It depends, excuse me. It depends on the program, but at Fledge Seattle, that would be every day for 2 months. So I get to talk to these entrepreneurs every single day for 2 months, and there is no equivalent due diligence that any investor can do to that. No VC, no angel group, no nothing. I'm literally with them for 6-7 hours a day for 40 days. Right? Did I get that right? 8 weeks, 5 days. Yeah, 40 days. So by the time they finish the program, I know as much about their business as any co-founder would. And I can go deeper if I want, but that seems sufficient at the moment. And with that, I then know how much they really need, and I know what their hurdles are. And by doing this enough, you get a really good idea of what's coming next, because you're just seeing patterns. And so I think you get a much better view of whether you have the right company to put more money into or not after 2 months of work, which does take work, right? It's 2 months of work. And so at the end, what you wind up with is a partnership with these organizations instead of a transaction. So you're not sitting on the opposite side of the table from them, having given them a 25 or 50,000 or whatever size check, if you do is the microfund model. You wind up sitting on the same side of the table as them, saying, okay, Well, we just spent weeks working on your financial model. It says you need X dollars. Let's provide that. And then, let's keep in touch every week after this to make sure that that was true. And it's almost never true, right? The plans still never come true, but we have a much better idea where we made a mistake, and there's no blame, and we'll toss a little bit more money to fix things. But we'll keep up that partnership for years and years and years later. I just love that model and think that's one of the alternatives that fixes a lot of these other issues.
So I want to talk a little bit about that, because I think it's important to recognize that angels operate in groups in different ways. And when you're talking about angel with the angel on this slide, you're basically talking about angel networks and individuals writing individual checks that do a little bit of due diligence and then struggle with the consequences of that structure.
Yeah.
Where micro VCs or managed funds have fundamentally different consequences of that choice, and active angel groups in the form of the kind of thing that I'm doing with the Angel Conference, where everybody's involved and everybody's spending time on it, you end up getting a bunch of the things that you're talking about.
Yeah, but also one difference I didn't put on here is at the Angel Conference, you wind up with this one partnership with one company. And at the end of my program,
I have several side deals that end up happening that are the consequence. But yes,
okay.
You're doing a better job of creating that, because my intent is to create the active angel group, which does more of what you're talking about at the accelerator.
Right. So the purpose of the Angel Conference and the purpose of Fledge are complete opposites in terms of who's getting the most benefit. I'm giving the most benefit to the entrepreneurs with eventual financial benefits to my LPs. You're getting the most benefits to the angels with some benefits to the one or two companies that get funded. Maybe it's 3 now with the side deals.
On average, it's 3 now.
Yeah. And so, I'm running a fund. It's run as a fund, but and I didn't know this when I started that this was the benefit of it. I just did it because I like startups. But it turns out that there's this incredible benefit of relationship finance that I haven't seen created at scale in any other form. And that's what made Africa Eats possible. And we'll get to that.
Can you take a minute to explain the difference between like the Fledge Accelerator and the Angel Accelerator, so people can contrast those a little bit?
So the Fledge Accelerator is for entrepreneurs. So the applicants are entrepreneurs. Again, they come from all over the world. It's very Techstar-esque in terms of the format of what we do when we get them in person. I like to do it in person. Some of my partners, that map was a map of partners. Some of my partners are running virtual programs, but they just don't work as well. I don't think they work as well. And so we have entrepreneurs. We're bringing them in for training. We're giving them a little bit of money. They're coming for the training more than the money. And we're putting their business plan in a much better forum and getting them to figure out what's coming next. It started as an idea stage. When I started Fledge, the entire industry was working with idea stage companies. So Techstars, Y Combinator is another one of these. And they used to say, you don't even need to bring a good idea because you're going to have a new one. That doesn't happen anymore. Now it's early revenue companies up to early growth stage companies. So typical company comes into Fledge will have $50,000 in revenue up to $500,000 in revenue already from the previous year. And our goal is to see them get to the $1 million a year milestone. And our hope is after that, they don't need us. But sometimes they still need us. And it used to be much more American companies. And then over the years, it became more and more overseas. And in most recent years, it's majority African. And then again, if I went back to that map, you'd see it was different programs in different places. And they're all run by different partners. And they all have slightly different geographies they target or slightly different sectors they target. And then the Angel Accelerator, that was an idea. It was inspired by some work I did in Singapore with entrepreneurship training programs out there. There just aren't the the breakthrough idea of that program was there aren't enough angels in the world, which doesn't seem like a breakthrough idea. But the breakthrough was there aren't enough angels in the world. So for all of these hundreds and hundreds of programs that are helping entrepreneurs, well, what we really need to do is help the angels. If we can create the angels, then we can fund the entrepreneurs. So why don't we run an angel-like conference, but run it with the startup accelerator attached to it? So we're teaching the angels how to be angels, but then they're taking their money and they're putting it into the startups in the accelerator. So we did that in 2020. And then we didn't run a program in we didn't run a Fledge accelerator in 21. So we did a couple angel accelerators that didn't do that. And most of that money wound up in Fledge anyway. So for lots of reasons. Okay, a few more slides and then we'll get to the conversation here. The other reason why I focus my time overseas beyond everything else is that I'm an impact investor. What does impact investing mean for those of you who haven't done that yet? These are the UN Sustainable Development Goals. This was a big bureaucratic process to try and organize what impact means. And these goals are used by governments. They also got adopted by impact investors. So this is just a way to talk about which impacts we care about the most. At Fledge, we care about 17 of these. At Africa Eats, we focus on poverty and hunger. And different impact funds focus on different one of these impacts. We just use this as a shorthand to talk about what we do. But most of the impact in the world, most of these problems of the world are bigger outside the US than inside the US. So if you're trying to solve poverty, yes, there are poor people in the US, but the poor people in the US actually rank in the top half of wealth or income in the globe. So when I talk poverty, I'm talking about people earning $1 or $2 a day. And the people on the street in Seattle earn more than $1 or $2 per day. Second reason is I'm a capitalist. I'm a pure-blooded capitalist. It may sound like I do things that are philanthropic. I run a charity, but no, I'm a capitalist. I do everything I do to make money. And one of the flaws of capitalism is that the money does not flow where it's most needed. The money flows where it's least risky. So if you want to make the most money, you should put it where it's most needed because that's where the opportunities are. So this is just a map of incomes, right? This is just a map of where the poor people are. And so you might think, well, why would I want to invest in a poor country? It's full of poor people that don't have any money to spend on anything. But if you go back and look at history, Europe was a poor place too 100 years ago, and it's not now. And China was a poor place 30 years ago, and it's not now. And Japan was a poor place 150 years ago, and it's not now. So there's no reason why this is going to be a poor place in the world in the next 100 years. This is where the opportunities are, right? Every place that's bright red on this map. You can make way more money with less risk in those markets than you can in the US. And that I'm going to dive into in a second. And the second one, and I think the last one on here, is that you should definitely deploy your money where it's most efficiently used. So efficiency in investing is, where does my dollar make the most growth? So, right now maybe they've cooled off with the stock market downturn, but the price you're paying per any unit in a tech company here in Seattle is just so high. I can't imagine why anyone's still doing it. Like, and it's worse in California. The only reason why Californians are still investing in California is because of that momentum of investing locally. Like, it makes no sense to me about the capital efficiency of that, right? And so I measure it as, I just measure everything as revenue. It's a nice, simple, universal measure. So when I invest $1 in an emerging market company, my expectation is that that dollar will turn into at least $1 of revenue next year. And I've been able to do that over and over and over again. Whereas in the US, typically it's like $100 or $1,000 to make $1 in the US. And so we've got real companies and real numbers to look at, right? Real grads. These are all Fledge companies. This is Zirconia. They graduated about 3 years ago. They raised $1 million, and even 2 years later, they were earning a few $100,000. Like, and that's okay. That's not considered a failure. Like, they were expecting to earn $1 million, but they didn't do it. Shift Labs, Fledge 3, Fledge 2, long time ago. Raised $1.5 million. They actually went to Y Combinator and came home with $1.2 million. Here we are, it's year 6. We've had some ups and downs, but it still hasn't earned $1 million. Like, so $1.5 million in, I think they just did another round. And it's still a small company. Then we got companies like Evernew. $10 million invested in this company. It's a chemical technology company. We knew it was going to take a long time. Without the pandemic, it probably would have made some money in 2020. But it's out there raising another $10 million to get through the next hump of growth. And they really don't have any revenues yet. This is the closest I have to the Instagrams and Facebooks and other big tech companies. Well, you can think of that. Facebook was making nothing when they went public, basically. Okay, flip side of that. This is a former cab driver from Seattle named Yusuf. He accidentally started a cook stove company in Ethiopia. It's the second largest cook stove on the continent of Africa. We ever put $70,000 in this company, total, ever. And most of that's me, personally. I just loved Yusuf, so I just wrote a check. I said, try and take less risk. I will not ask any of you to invest alongside me here because there's an active civil war going on in Ethiopia. So that's not a place you should be risking your money. But nonetheless, Africa Eats is about to write them a $200,000 check. And we're doing that because it's working. So we'll take that risk, but we won't tell you to take that risk. And we already survived 2 years of civil unrest based in the home city of this company. And they're still, 70 grand is earning 270 a year, paying all the bills, growing, and it's most popular cook stove in that country. I think it's for the amount of political and military issues that have gone on, this company's done great. And you can see just in efficiency, it's okay. Down in Malawi, we invested $115,000 with a co-investor into a company called Soweto Enterprise. So we're actually the smaller investor. And year 6, they're basically growing at about 50% year over year. And here last year was year 6, and it was $845K. So you go, okay, that's nice. But again, if you get the right alternative structure, this is a nice investment. And in terms of value,
explain that. Explain how this can be a possibly good investment given the lack of exits.
Well, one of 2 ways is that I'm using. Well, just imagine you get 5% of the revenues. Okay, until you get back whatever the multiple is that you negotiated. So if you're supposed to get back, twice what you put in, and you put in, 25K of this investment or 50K, because a big chunk of this was a VC that came in called Hivos. So Netherlands-based VC came in with preferred equity, just normal everyday preferred equity. So take that part out because they're not trying to get their money back out. So there's only $75,000 of alternative money in here. And so if you're trying to get back 150K at 5% of revenue, it takes a few more years, you'll get paid back.
So you're using a model called revenue redemption where you have stock and then you're asking them to buy the stock back at a multiple of 2 out of 5% of revenue.
Yeah, and the reason I'm being vague is that yes, except we undid that when we did Africa Eats. So we have a new model we're using. So in the new model, you can think of it as Berkshire Hathaway, right? So it's a company everyone's probably heard of. You may not know how it works. Berkshire Hathaway buys minority and majority stakes of companies. So Duracell Battery is not an independent company. It is Berkshire Hathaway. So is Fruit of the Loom underwear and Russell underwear now, Russell t-shirts, and See's Candy and Geico Insurance and BNSF. But also 1/3 of Heinz is owned by Berkshire Hathaway, and about 8% of Apple and a bunch of other companies as well. And the way Berkshire values its portfolio is just whatever that total is, whatever the total value of all its entries are, all its investments are. That's the value of Berkshire Hathaway shares. They don't take the money out of those companies. They don't distribute dividends. It's just a capital gains play. So Africa Eats is like that. So this is one of 30 companies in the Africa Eats portfolio. And we put in the whatever $75,000. So we handed over, Fledge handed Africa Eats its investments in these companies. So we is now Africa Eats. We put in $75,000. We own, I don't know, it's like 24% of this company, something around that. And so we own 24% of whatever the value is of this company. And we simply value it as 4 times its revenues. So that's $2.4 million, $2.5 million. We own 24% of that, more or less. Call it 20 to do the math. So we have about $500,000 of value in this company from $75,000 of investment. It's pretty good. It's not liquid yet, but I'll consider that a pretty good win so far. And the company keeps growing.
Well, continue the path until it gets to and it's liquid part.
Yeah, we'll get to we can do that at the end.
Okay.
So a few more examples. Chicken Basket, largest chicken processor in Western Kenya. Total of $200,000 invested to date. They did about $900K last year. In this case, it's mostly Fledge money, Fledge and Africa Eats money. Type of growth we're seeing. A few other ways I'm showing this. We met this company at the end of 2019. So roughly $100,000 in their 3rd year of business. Fledge gave them $20,000. Africa Eats gave them $55,000. That's all the money that was invested in 2020. And so I think 2019 was that $20K. It got them doubled. And then they got a 5-fold increase in 2021. Again, it's tiny bits of money going in, large amounts of revenue coming out, and profits. All these companies are profitable. Same thing with Regathe Dairy. We met them at the end of 2019. This was 20,000 from Fledge and 2 angels that came in. That grew them 9-fold in 2020, 2 million too. Then there was a drought in Tanzania that slowed down the growth to less than 2. And then the drought continued on into 22. So they're actually going to drop a little this year. But nonetheless, it's $65,000 investment for a company earning over $1 million. We met this one in the middle of 2018. They went to the program in Italy. That's why it's in euros. And in terms of equity, like there was no equity investment. There was this equity investment in 2018. And then we gave them enough to buy a truck at the end of 2021. I love this. Is kind of just a bootstrappy kind of company. And they just double every year. Like I'm not showing every year, but they're just on the track of doubling every year. They sell honey. Just like that is their product. Sometimes it's more complicated. This is an entrepreneur. I met them way back in 2016. It's a meat processing company, so butcher, and they make this packaged meat product. It's in Rwanda. So when I met them, this company was earning $30,000 a year, or $25,000 a year. They were literally running a company with a hand-powered meat grinder and a hand-powered sausage stuffer. And almost nothing's been invested in this company. It's $100,000, but most of that's recent. And they did $600,000 last year from the meat company, and they had spun out their livestock production, which we just merged back in. So you add those two together, and trailing 12 months of those two is $1 million. Then they spun out their logistics company in 2020. Africa Eats invested in that at the beginning of this year. Total company, this is all one entrepreneur. Total empire he's building is trailing revenues close to $2 million right now. All on, including the truck investment, like $300,000 ever invested. And then the oldest one, and the one that kicked me off on this whole Africa thing, was East Africa Fruits. We met them in early 2014. Year one was $100,000. They had created $100,000 of revenue in a break-even business on like $4,000 of capital. That was from the founder. So we gave them 17,000 back then. We didn't have any follow-on back then. Some angels chipped in 50K more as a loan, traditional loan, just 12% interest loan. They got repaid by like 2016, I think it was. And that company, just with that little push, made it to 1.1 million by 2019. Then they got some funding. Then they got a Series A in 2020 that was about $2 million. Not showing that on here. They did 5.5 last year. So I've seen them do 55 times growth already. They're on track to do 12 million this year. Growth is not slowing; it's actually speeding up. And we just put in some more money as Africa Eats into this one. But I'm about to see my first 100x growth of any of these companies. So, historically, when we look at just these 30 companies that came through Fledge that were in Africa that we threw into this Africa Eats portfolio, this is the growth we've been seeing from them. So if you're totally trained on the VC model and you're expecting like 3 times growth every year, now just be clear, that's like the winners. This is the entire portfolio. They've already done 10x growth. They did 10x growth from 2016 to 2021, so it took 5 years. Compounded growth rate's been 60%. Growth rate for 2020 to 2021, this little line is a little steeper. It was 70%. And they've done 16 million of revenue on 3.4 million in total investment capital. Again, where the opportunities lie and where the efficiency is there. And the reason they've been able to do this is because the opportunities in front of these companies is huge. It's like 1,000 times bigger than these companies, and there's basically no competition. And unlike the other reason I'm bullish on this is, again, I spent 20 years in tech. I can speak product market fit if you want, and I can speak about, customer acquisition costs and all the normal metrics. But ultimately, all that boils down to is we've launched a company, we don't know how to get it to profitability yet. We think we do, but we don't know how to. Whereas I don't deal with any of that anymore. All these companies in Africa, they're all profitable. Our challenge is, how do we keep up a growth rate of 50, 60, 70% year over year? Because that's a nice, comfortable growth rate that doesn't stress everybody. We don't have enough capital to do any faster than that if we wanted to. But just how do we, my question to them is always, what do we need to double sales? And is that going to be next year, or is that going to be 2 years from now? And we just talk about that, and we then try and find the funding to go do it. So when we look forward and say, how long until this is $100 million of revenue collectively, it's about 5 years away. And that's assuming growth slows down. And so that's assuming we have capital to help them grow, because we think they'll slow down a little faster than that without the capital, or they just won't be able, they'll hit a wall. They just won't be able to keep going. But we see them as a $100 million a year group in 25, and the next 10x of growth, in the 26, 27 timeframe. And so the purpose of this entity, which is called Africa Eats, is to be like Berkshire Hathaway in Africa, and to take this portfolio that grows and grows and grows and grows in value and ultimately make it public, make the portfolio public, not the companies. The companies can be independent if they want. They can be acquired if they want. They can go public if they want. But the portfolio of ownership becomes a public entity. And we'll do that in Africa as soon as we can, and then we'll be public in London. London, because there's 127 African companies listed in London, and I only know of one in New York. So we're going to London. Okay, last little bit. This isn't just me. Right, so all my funds together are just shy of $10 million. So I'm not even a pixel on this map. The amount of investment that's flowing into Africa is taking off, and last year was the big, stellar year. And so this is the amount per year. The metrics of tracking this in Africa are not up to the spec of tracking in the US. So I've seen this number as. This one's showing 4 point something as of November. Another chart said 5.2 billion. Another one said 4 point something. It's somewhere between $4 and $5 billion. It's a large sum of money. So we're off a little bit, but we're in the ballpark of measuring. And in terms of how this is changing around the world, of course, there were a lot more money invested in VC in the US as well last year. But the growth rate in Africa is faster than anywhere else. Right? And again, I think that's because people are starting to wake up to see there's this if you don't know, there's a 1.1 billion people living in sub-Saharan Africa. Soon to be 2 billion people. They need everything. And so it will be the fastest growing place on the planet. And Latin America is, also fast growing in case you just want to go south. And India is still growing, and Southeast Asia is still growing too, but the capital is just not growing as fast out there. Okay, and lastly, I think this is my last slide. I have 2 more slides. It's not concentrated. It's not spread out evenly. It's concentrated into a few countries. So the number 1 place for angels who are dropping onto the continent and new funds is Nairobi, Kenya. And that's not where Nairobi is. That's nowhere in Kenya. Nairobi's about here in Kenya. Just like San Francisco's the place to start for tech startups, Nairobi, Kenya is just the place that people are going to. It's just, there's no reason for it. It's just, that's where the momentum is.
Seems like Nigeria is bigger.
Yeah, so Nigeria is a bigger, highly populated country. This is about 50 million people, and that's 100. And Nigeria has an oil industry. Nigeria is an oil state. So the numbers, when you see them, are not apples and apples when you compare Kenya and Nigeria. Nigeria has an oil industry, and they produce plastics, and they produce more manufacturing in Nigeria because it's more industrialized. And Kenya has less of everything. And so when you see numbers that are showing Kenya and Nigeria to be about the same amount, far more of this money is going into startups, and far more of this money is going into larger industrial projects. And so it's just like you can't compare South Africa to anyone on the continent, because this is kind of a much more developed country that's having political issues, but it's much more developed country. So it's kind of Kenya and Nigeria, but Kenya first, Nigeria close second. And then the distant thirds are Accra in Ghana, Kampala in Uganda, and Kigali in Rwanda. And then that's it. And then past that, I do a lot of investing in Tanzania, but others don't. Everything else is a very, very distant, fourth. It's kind of the equivalent of, you can call these 2 San Francisco, you can call these others up here New York or Boston, and then everything else is Atlanta. Who cares about Atlanta except for Atlantans? Like, who in the U.S. cares about the startup ecosystem in Atlanta or Miami or San Antonio? Austin, yeah, but San Antonio, no. San Antonio is Malawi. Okay, and actually this is the wrap up, which is you should put your money where it's needed, because that's where the opportunities are, and you should put it where it's efficient. And hopefully I showed you where efficiency is. Oh, and have some impact while you're at it.
So talk about that process of getting liquid.
Okay, so the process I'm following is one that is rare, but not unheard of, but rare, which is use the public markets as a place to go turn equities into a liquid asset. So we've seen that with companies in the US for decades. And in Africa, when you go and look at their, they have pretty thin stock markets and no market makers in there. They're not super liquid, but when you go look at what's listed on their markets, you often find holding companies. And so there is a pattern of, we've invested in a handful of companies, and now you can buy into them. And the stock markets in Africa are not, they're open to everyone, but they're still only owned by the top 2-3% of the population.
So when you see holding companies going public, what level of assets do you expect the holding company to have to sort of hit the minimum bar where the going public overhead makes sense?
The overhead is almost nothing.
Well, if you got to do your reporting and you have to do your accounting, you're going to end up spending maybe $60,000 to $100,000 a year on staff just to get the basics done.
Yeah, you know what? You have the American bias, right? So
I do.
To be public in the United States is going to cost $2 million a year. Right? It's going to cost a minimum of $5 million to go public. A SPAC, I saw SPAC spending $1 to $2 million to list a SPAC, which one of them had a 7-page S1. and spent $1 million on a 7-page S1. And just the fee per year to be public in the US is like $250,000. The fee to be public on the Nairobi Stock Exchange is something like $5,000 or $10,000. So that's nothing. The cost of we're paying, I think it was $4,000 for our audit. So 10 times less, right? 1/10 the cost. Everything's less expensive. All the professional pieces are less expensive. So our expectation on what it costs to be a public company in Africa, we budgeted $100,000 for the whole process. So that's everything, including all the legal work and all the accounting. And then ongoing, it's so small it barely moves the needle, right? It's a few tens of thousands of dollars, we think. The bar to be public depends on the country. In Nairobi, I went to their office and sat with the stock exchange. They said minimum to be a viable IPO is a $25 million valuation. That's it. So you don't have to be a gigantic company to be public. That won't make you the smallest company on the stock market, because there is an alternative, which is just list. For like 50K, you can just list your company. And some people do follow that path. I did also talk to the CEO of the Mauritius Stock Exchange, which is the second biggest in the continent. And I got a list of all the market caps of all the companies, and we talked about listing. We already qualify. I did this last year. Last year, we would have been the third smallest of 45 companies on the stock exchange. Right now, we would probably be the fifth smallest. I think we moved up 2 spots. And it's power curve. Biggest one's worth $1 billion. It's the bank we use. But most of them are, tens of millions or maybe $100 million of value. And then in London, the minimum expectation to go public is 100 million pounds of value. That's it. So again, not billions of dollars, right? 100 million pounds, so $120 million of value. And then that's a fully liquid market.
Which you expect to achieve in 5 years.
We should be big enough in 5 or 6 years to meet that threshold. Yeah, assuming we raise the money we put in the budget. And if that takes longer, then going public will take longer. So that's our risk. But the view is, if you just think about venture capital in the normal means, and I have a whole other lecture on that, how that works. They call them 10-year funds. No successful venture capital fund I know of actually lasted 10 years. All the successful ones go longer. The failed ones go 10 years. And so they go 12 to 15, although I heard one that went 17. So you can think it takes 12 or 15 years to get your full return back from a venture capital fund. So when I say we should be big enough by 26, 27, we started in 2020. That's within 10 years. So if I'm wrong and we get out to 2030, I'm still within the right range of a venture capital fund.
Yep. I see James Tuft has a thing in the chat that asks if if you are doing things with mining, since there's lots of gold in Africa.
I don't. So everything I'm doing in Africa is food and ag related. And the reason why we chose that is a few reasons. One is we're impact investors and we want to do the most good in the world. We can create the most income spread around the most number of people with food and ag. 80% of Africans are farmers. It's a highly agricultural place. So we're buying from those farmers. We're not doing food and ag like in Iowa by buying farms and land. We're just simply buying food that's produced by farmers, and that doubles their incomes, which gets them out of that $1 or $2 a day, and it gets them to the middle class. So we're fighting poverty. I said I'm a capitalist. I'm fighting poverty by buying the output of producers.
So Jonathan asks, how many more companies do you foresee putting into the African Eats portfolio? Where does that stop?
Yeah, so my partner's Jumane. Everybody in Africa Eats is African but me. My partner lives in Lagos. We talk about this a lot. We have a strategic discussion every week at our weekly management meeting. And I don't have the answer yet. We are of two minds of, should we double down on the ones that are growing the fastest and the biggest at the detriment of the smaller ones? Because there's never going to be enough money. No matter how much we raise, there will never be enough money for everyone. Or do we get them to the point where there are other funders that will fund them and then let them go and then focus on the smaller ones and get them up to that size? And historically, we've done some of both, and we don't know the right answer. So I can't answer the question. We have at the moment, there is, through my other work, through my nonprofit, one company we lent money to with the nonprofit, and they just came back to me. I'll ask the crowd what we should do here. So there's a company in Tanzania. Historically, they took the leftover avocados that weren't up to snuff to export, and they pressed them into avocado oil, because those can be ugly avocados. And it's a tiny little company. They're earning like 50 grand a year doing that. Totally fine. We lent the money through the nonprofit so they could plant, let's call it 25,000 trees. And in 3 years, they'll have their own avocado trees from their own crowd of farmers, and they'll do a lot more of the avocado pressing. But we have to wait 2 or 3 years for those trees to mature. In the meantime, the price of sunflower oil has skyrocketed because Ukraine and Russia are the two biggest producers. And sunflower is a great cooking oil. They said, well, we could go buy the third biggest producer of sunflowers is Tanzania. They said, we can go buy sunflower seeds here. We could press them into sunflower oil. Here's a business plan. We could make 45% margins, 51% margins on this. Right now, those sunflower seeds are exported to Indonesia. So this is a import mitigation, whatnot. Anyway, they asked us for $21,000. They said, if you give us $21,000, we will turn that into, I don't remember the number, exact digits off the top of my head. Let's call it $55,000 of revenue at 50% margins. Seems like a good deal. And it could be an equity investment, and we could have a nice little stake in this little company, right? And they could go from 50,000 a year to 120, given their projections from their other work. And then next year they'll grow bigger. And the question is, should we do that or not? And the only reason not is because we have way more asks than we have money. And should we instead give the make that 21,000 part of a $100,000 or $200,000?
Why are you not taking this out to your investor network and getting more money?
Well, we will. But
so then
the question on Monday,
the shortage of money is a shortage of marketing, not a shortage of money.
Part that, part we just went out to our investor network not too long ago and many of them joined into Africa Eats without a specific ask involved, because we're not in the business of creating syndicates for little individual deals, because basically we get first dibs to just take it or not. And so this was the conversation Monday, and it's Thursday now, and I haven't had a chance to go and push it out. And because we literally have like 5 other deals of five bigger sizes that we could also invest in. And we could also package up and send out to the investor crowd. And I have 2 in Fledge at the same time that do need the investor crowd. So part of this is what we really need that would help our companies and lots of other companies is what we really need is our crowd focused on this.
You have to explain our crowd. Not everybody will know what our crowd is.
Okay, so does everyone here know what an angel list syndicate is?
I think we probably do.
Okay, so the key that made what I understand is the key that made angel list syndicates work is that somebody that people trusted per syndicate stepped up and said, I like this deal. There's this company in Tanzania and I think it's great, and I would invest if I had or I will invest X dollars, please join me. Our crowd took that a slightly different direction and said, okay, and this is 7 years ago? Mm-hmm. They said, okay, we're going to set up a venture capital fund. This is an Israeli-based fund investing mostly in Europe and tech companies. But they set up a medium size or medium small size venture capital fund like 50 million. It's not huge. But what the twist they did is they said, well, every time we find a company we like, we're going to do the due diligence, we're going to write the term sheet, and then instead of syndicating it to another venture capital firm, we're going to list it on our website. And if you as an angel would like to join that website, you're free to do that. And then you can choose as to join into a SPV on every deal individually. So you get the trust and belief that a VC is behind this deal, but you as an angel can pick them individually. And there's something like 50,000 LPs on this platform now. And the venture capital fund's much bigger.
They're crowdfunding angels.
But it's not crowdfunding cold, it's crowdfunding warm, which I haven't.
Well, most of the crowdfunding platforms are moving to this format where they're looking for lead angels to anchor the crowdfunding deals to do this. So that pattern is starting to happen more and more.
Yeah, okay. But this is the only one I know of where the lead is a VC.
Yes.
The lead is a fund as opposed to an individual.
Yes.
So I believe that would add to the credibility here. So yeah, if I had infinite amounts of time and resources, I would spin up our crowd for Africa Eats.
Yeah.
And I've reached out to them and I said, hey, there's an opportunity. Can we have an instance? But they haven't even replied.
We can help with that if you like.
Please.
All right.
Or any other site that you know of that could take that form.
Well, I think that between you and I, that we have enough angels in our network that we can solve all 5 of your little project things if we craft the marketing message.
Okay. So here's my ultimate.
I don't think we have to do a big problem. We just have to get our own communications functional.
It could be, and then could do it on a manual website and all that. But I would love to have it to the level of at least maybe not as sophisticated as Our Crowd or WeFund or Start Engine, but somewhere along that path, as opposed to here's some deals. Email me if you like them, and coordinate. It's the cat herding that's the hard part. With lots of angels. And I have now, in 10 years of this work, 82 LPs in the Fledge fund, all of those plus 12 more in the Africa Eats organization, holding company, plus 156 more that came in through WeFunder, plus I think it's another 103 on the nonprofit side that use their donor advised fund. So I have a large crowd out there, but that's the good news. The bad news is it's a large crowd and it's very hard to coordinate.
Yeah. So Abestor, which I just put in the chat, is contemplating what you just said. It might be a worthwhile conversation with them to see if they'll run the experiment.
Okay, thank you. Yeah, and ultimately the issue I deal with every day is if I went out to, and I do this at Africa Eats, if we go to Africa Eats and ask all 30 companies what their needs are, what their ideal fundraising goal is for the year, it's like $10 million worth of funding. If you add in the fledglings, it's like 15 or 20. And I do this every few months, and it goes up every few months because they grow. And not every single one of those is the best use of funds. Some of those are aspirational and need to get shrunk. But it's not a small amount of money.
Inside Africa Eats, you have a fund.
No, it is a holding company.
Okay.
And so it deploys its capital as if it were a fund.
Okay.
It is not a fund.
Where does it get its capital from?
From individual investors.
And they're buying private stock.
They're buying stock depends on the size of the investor. For the $50,000, $100,000 investor, they're buying units in Fledge into an SPV that invests in Africa Eats. And for the bigger investors, like 200K and up, they're buying shares in Africa Eats directly.
Yeah. All right. And so, yeah, my thought is that the rolling fund model that Oregon Angel Fund uses is an easy mechanism for gathering groups of cats to invest in things. Yeah. And so having that mechanism in play that allows investment into the mechanism would be a way to, they're currently investing $15 million a year out of Oregon Venture Fund at this point. So that mechanism seems like something that would be useful.
Yeah, so I use Fledge to be that mechanism.
Okay.
So every year people invest into Fledge. Most of the capital gets in the last 2 years has been earmarked for Africa Eats. occasionally gets earmarked for a fledgling that has a need as well. But we're talking about international stuff, so I'm talking about the international needs.
All right. Does everybody understand what a rolling fund is? So normally what Luni was saying is that, you set up a venture capital fund, it's got a 10-year lifespan, you have a 4-year investment period, and then you have to manage the investment. A rolling fund is like Calm Fund utilizes a quarterly subscription. So they'll do a subscription of $10,000 a quarter. And then that year is an annual investment period. And then they start a new one each year. And so each year you're basically investing 40,000 a year, but it's an optional 40,000. Each quarter you make a decision on whether the 10K goes in or not. And then it's basically a cash flowing model as opposed to a capital injection model.
And yes, and in the VC model, you're pledging a certain amount of money at the beginning, but you're not actually writing that check. Right. They're going to call that money over 5 years or 6 years. So if VCs tend to be bigger, if you've pledged $500,000 into the fund, you're probably only going to write a check of $100,000 a year this year and $100,000 next year and onward. And it's going to vary per year. And you have no control over that either. Whereas in the rolling fund model, you put in whatever you want this year, you put in whatever you want next year, and so forth, with the only caveat that it might get popular and they might cut back on your pro rata.
Right. Other questions that people have? Anybody excited to invest in Nigeria or Kenya or Tanzania? Anybody know anybody who wants to invest in margin instead of gross? I think that's the magic of what you've done with the revenue redemption, is that margin is the thing that allows you to extract the value for the investor. I think that's quite fundamental. I think it opens up a lot of opportunities.
Yeah, I will say though, the holding company model raised more capital from investors than the revenue model did.
Interesting.
And I think that's because it's much simpler to understand. Put in the money, and in a few years, we don't know how many, but in a few years you will have the option to have it back. But you don't even have to take it back in that model. You can give it to your grandkids in 100 years.
Right. Right. So when people want to think about Africa Eats, they go to africaeats.com.
Mm-hmm. Yep.
And when people want to think about Fledge, they go to fledge.co.
Yes, and I'll put that in the chat window, but if you're listening to the recording, then yes. It's fledge.co. Some squatter never gave up fledge.com. And if perchance you have a donor advised fund and want to use that to invest, that's realizeimpact.org. So explain what a donor advised fund is, because not everybody knows. Okay, so there is a longstanding structure in the United States. There are about 2,000 organizations, all nonprofits, that run this structure. It's generally called a donor advised fund. You donate money to that nonprofit. Oh, and the biggest three you've probably heard of and didn't know what they were, which is Fidelity Charitable, Schwab Charitable, and Vanguard Charitable, because they make them look like they're just part of the brokerages, but they're not. So those are 501c3 organizations. And so if you have a good year, this is mostly done for entrepreneurs that have a good year, or you sold a piece of real estate, or you inherited a large sum of money, but you had a good year, you have more money than you think you need that year, you donate it to your donor advised fund. You will get a tax deduction for that donation that year because you have donated to a 501c3. The interesting part, though, is that they will take that money and they'll put it in what looks like an investment account. And they will make it act as if you still control it, even though it's not your money. You've given it away already. And then what you can do with that money is you can move it around in different investments, but you can never have it back. It's not your money. You've given it away. And generally what people do with those is that they will then use them to do their philanthropy year after year after year. So I sold a tech company. I had a tech company got purchased in 2014. I took 5% of everything I got and I put it into impact assets. I've since moved to Fidelity. And I'm still giving away that money.
Why did you put it into Fidelity instead of impact assets?
Impact assets increased their fees last year for people with smaller amounts of capital.
Okay.
And I'm a poor rich person, I like to say.
Yes.
And so I got hit by an extra fee, and I got pissed off that they were charging me more, and I don't have as much money as my friends. They charge them less. That's not fair. And Fidelity overall charges less fee anyway. And I've been a Fidelity customer since I was like 16. So I just moved it to Fidelity. It took 2 minutes. And now when I log into Fidelity, it's literally one of the accounts. I see my checking account, my savings account, my investment accounts, and my DAF all on the same page.
So it's possible because of the accreditation laws that you can angel invest out of that.
No, it's even better than that. So Realized Impact started a service in the beginning of 2020, right before the pandemic. We will take recommendations from you as an investor. So we're the accredited investor. We'll take a $10,000 or higher donation from anybody and a recommendation on where to invest. And as long as it's impactful, we'll make the investment. And then we'll manage it like an investor would. And whatever we get back, 99% of it goes back into your donor advised fund.
So you can make you're doing basically a 1% distribution fee, not a carry.
Not a carry.
And you're not charging annual fees, which all of the other ones do.
Correct. So the way that donor advised funds, except for one, make money, is that they charge you an annual fee, just like a wealth advisor would. They tend to be 1% to 2%, like wealth advisors charge. We don't do that. We charge $500 to make an investment. So $500 for us to do the paperwork. And then 99% of the total return goes back to you. So if you make a good angel investment in it, and
it goes back to you as a person, or it goes back to you as a DAF?
Goes back into your DAF. And again, it feels like your money. It's not legally your money, but you gave this to charity. Now you can do some investing with it. It can grow, and you can have more money to give to charity at the end of your life, or you can pass a DAF on to your heirs. That's possible as well. Yeah. There's unlike foundations, there's no minimum per year. You can just leave it there if you want. Congress is trying to change that, but historically 20% of DAFs get spent every year. So there actually isn't a problem there. There's only 1 or 2 DAFs that will invest into private companies. Impact Assets is one, which is why I went there. But they charge an extra 1% per year fee for that. So if you have a 10-year investment, you give them 10% of the upfront amount of money.
And Legacy Global is the other.
There's a few. Impact Charitable in Denver will do it as well now.
Okay.
And Fidelity will do it for their giant customers, but not for the normal people like us.
So James asks a question.
We do not have anything working in blockchain at the moment. No. I haven't seen too many impact block fund or blockchain things or impact tokens. I've seen a few, but
there's several that are working on land management and ownership rights and putting them on blockchain as a mechanism to drive that. There's a couple in Africa and one in India.
I've seen the most impactful ones I've seen have been putting carbon credits on a blockchain.
Yep. Like Nori would fit into that model, right?
Yeah, I saw Nori and a bunch of friends invested in it. But I've seen 2 or 3 since then as well.
Yeah.
I have seen, we did have one company come through the Nature Accelerator. They were selling trees, and they had set up a internal only, their own blockchain where they were recording every tree that they planted. That was also the one from one of the 2 from the Republic of Georgia, and it blew up. It didn't work out. Not because it was the team thing, not the business plan was fine.
Right. Any other thoughts? Jonathan, you turned your camera on. Got an exciting question to ask?
Oh, I just thought it'd be nice to share my face. No questions.
All right, like that. So you've been through Seattle, Jonathan. You've been through Seattle Angel Conference. You've been through the Angel Accelerator with Luni. you're trying to get going with your angel investing. What's the next step that would be impactful and cause you to invest in that direction?
I joined E8, and so I'm learning the ropes there and getting to see deal funds or deal flow. And what I'm looking for, I guess, would be one or more companies that I'm comfortable enough to, like I said, dive in and be a member of the team in some capacity.
Yeah.
Active angel.
Yes.
Yeah. Well, at the point where you join the team and you become a co-founder or you become a key employee, you're no longer angel investing. You're becoming a captain of industry, which is a fundamentally different asset class.
Oh, I've seen plenty of angels that are active, but not 5 days a week active.
Yeah, it's a spectrum of involvement. So I don't know where I'll be on the spectrum.
Yeah. All right. Anything we can do that'll help?
No, I mean, the fact that you exist and have conversations like this is awesome. So thank you.
Thanks. So Luni, anything we can do that'll help you?
Yeah, let's keep talking about getting the all the graduates together to look at deals.
Yeah, so there's a group in Austin, and I'm forgetting Sputnik Labs, I think, that I've been sucked into their content strategy, right? And they just ran a event, which was essentially a pitch event, an investing pitch event using a thing called stonks. And I've been thinking that what we should do is to try to collect my alumni investors together and take our alumni companies that are on their next step and just do a pitch event and see if it warms anybody's cockles and see if they move forward, right? So try and figure out the format of that cat herding so that it's less chasing and more checks being raised.
Yeah.
So let's talk about that.
Okay. Sounds good.
Cool. Michael, anything you want to say?
Oh, just soaking it all in, John. It was a good talk. Thanks, Luni.
Yeah, you're welcome.
Thanks.
If anybody wants to go deeper into this opportunity or what Fledge does or whatnot, just reach out. I'm Luni at a lot of things. We can just use Luni at fledge.co. It's the shortest one.
Cool. James, any thoughts?
Sorry. Yeah. Thanks, John. I think this sounds very interesting. I'm just thinking through what Luni's talked about in Africa, and I've done several deals in Africa, and all of them have gone bad because of corruption and illegal people doing illegal things. And I'm just kind of curious if Luni, if you've had any challenges, around criminals.
No.
Other than a fish farm being destroyed.
Yeah. Well, so here's all the negatives that have happened, right? Everything I can think of off the top of my head. We had a fledgling, not Africa Eats company, but a fledgling years ago. He was recycling motor oil in Uganda. Beautiful man, just a lovely, lovely, lovely human being. And the government decided, because the government owns the president owns the oil industry in Uganda, or some of the oil industry. He decided this was competitive. And so he arrested the entrepreneur and his staff and threw them in prison. And a few of the workers died, and my guy was literally tortured and bought his way out of prison. So there's nothing bad on my side, but on the Ugandan side, that was terrible. Pissed me off completely, but there's nothing I can do about that one. We had our fish farm. It was looted after the lockdowns in Uganda, also Uganda, coincidentally, Uganda. So the neighbors came in. They didn't loot the part where we were growing the fish for market. That would have been okay. We could have lived with that. They looted the hatchery. So they stole the parent fish that we used to make the eggs. And of the ones they couldn't steal, they poisoned all of the ponds. So we lost about $200,000 worth of fish, and all the breeding stock. We later discovered that it was actually instigated by one of the workers there, who thought that if this happened, he would be able to take over the company, and thought that the owner would show up and he would get beaten to death, and this guy would take over the company. So that guy's now in prison. And yeah, Africa Eats came in with $100,000 to restock the hatchery, and save the company, or not save it, but get it back on its feet faster. Let's see. What's the other one? Well, those are the worst two I can think. I can't think of the third one. Oh, I had a fintech company. I have a fintech company, and the CEO was trying to close a deal with the savings co-op of the police, and it seemed like in the end he was getting a kickback for doing it.
Yeah.
And so we asked him to leave the company. And there's actually a lead angel on that deal, and he was the one dealing with it. And so I jumped in and just got the two sides. I was the mediator. I got the two sides of the story. And yeah, he was a little shady in terms of what he's doing as CEO, but really his only flaw was that he just didn't tell his lead investor he was doing this, his board member. If he had simply said, in order to close the deal, we need to do X, then we would have had a conversation about whether X was a reasonable thing to do or not. And the CEO just did it anyway. And so we kicked him out of the company. The company's then got $1 million investment and is doing good after that. Other than that, I have entrepreneurs that just disappear once in a while because they're bad communicators, but they always pop back up again. And that's it. Other than that, I'm finding, maybe it could be that I'm dealing mostly with impact entrepreneurs. Just finding the most incredibly lovely people to work with.
Well, and part of it is that you typically find people that you bring to Seattle and you spent 40 days with them. And if they're a little bit wonky, you figure that out pretty quick.
Yeah, but even then, there's only, the 100 and something that we've done that with globally. There's only like 3 or 4 that turned. Oh yeah, there was one more Nigerian. I'll tell you one more story. There's only like 3 or 4 that we know we made the wrong decision on, like because they just weren't the right people. We got 123 out of 125 actually turned out to be really nice people and decent business people. And I chalk that up to being focused on impact, that the entrepreneurs who have dedicated themselves to impact tend to be nicer people than the ones that do tech. And I can speak with that as 20 years of tech. And the same thing with the investors. Like I've only met one asshole investor in all of impact, and he was former Kleiner Perkins, right? Who thought he was doing impact. The other one was, we didn't even get that far. We had an entrepreneur, he was Nigerian. We invited him to go to Fledge, Peru. He seemed like the perfect fit. He was doing a drone ad company. He had worked at Airbus before, so he had the creds to do that. And then like 6 weeks into the program, he just seemed to lose it. And he started complaining, and it turned out that his wife and child were evicted from their home while he was in Peru. And it was because he ran out of money, and he never bothered to tell us that he ran out of money, or we would have covered that so that wouldn't happen. And in the end, it's the only time I ever had to go to the lawyers and do anything. And we sent him a cease and desist letter. He was starting to send out news that, Fledge is a scam. And so we had to put an end to that. And it turned out he never actually published it. He just sent us an email trying to threaten us. He basically had a breakdown. That's it. That's all I can remember. And it's been 40 investments in Africa and a whole bunch in the rest of the world.
Thank you.
Dong, how about you? No? Off you didn't
Me?
click? Yes. Do you have any questions or thoughts? I'm just making sure everybody has a chance to talk.
Oh, no, I'm just learning from everybody.
Yeah?
I've been to Africa as a tourist. Yeah, the corruption's rampant, even on normal road.
Yeah, it's just legal here. Like, just be clear, like the political corruption, it's just legal here. We call it lobbying. It's the same system.
Yes.
Right.
Just like when you said that this guy came and poisoned the plant. Just these smaller crimes are more rampant there than here. Here you don't see that as often, but true, we legalize the bigger crimes here.
Yeah, and there are, I hear there are shakedowns where there be, it looks like a checkpoint, and they'll be checking papers and whatnot and asking for a fee to pass.
Yes, those are very, very common.
Yeah, it's a little bit of money. There's another legal system in Tanzania at the moment where if you want to drive a commercial truck through a town, you have to have a sticker, and they'll pull you over if you don't have the sticker. And so the dairy company, I showed you the 9X Growth Dairy Company, was complaining that, they have like 16 trucks, and if one truck breaks down, the other truck doesn't have the sticker. And they're like, and it's and they give me the number in shillings. It's like, $10.
Buy 16 stickers.
Yeah, literally with 16 stickers on some of their trucks. And that might be $100. And in the scheme of things, for $1 million a year company, that doesn't make any difference. But John and I are complaining about herding cats. And one of the issues that this entrepreneur has to deal with is just making sure that the truck going in the right direction has the right sticker on it. And if not, it's like $10. And $10 to him is like one of his drivers for a week. Like, they're only getting paid like $3, $4 a day. So $10 is a big deal. Or we got all the entrepreneurs together in Nairobi last November, which is fantastically fun. And one of the issues that they were talking about was their drivers steal their gas. And so the question was, well, how do you stop your drivers from stealing your fuel? And and they have 8 different ways to solve that, and they were sharing those ways. But you just have to expect in your budget, you budget for more fuel than you need, because some of it will get stolen. But again, you get a company up to scale, none of these things are deal stoppers. None of them make any big difference. And the cost, we didn't go there. Like the reason why US companies cost so much, the reason why they're not capital efficient, is because we have to pay Americans to be American. They're just expensive. You want to hire someone on staff, it's going to cost you all in. You might as well call it $100,000, because that's what it's going to be, unless you're doing a software company, then it's 2 or 3. And in Africa, we don't even look at that line. The cost of the people is so low that it's insignificant. The fuel cost is higher than the people cost. And literally, that Ugandan fish farm, I went to go visit. They had 8 ponds at the time. They wanted to put in 20 more ponds. Each pond was, I think it was 8 guys, $3 a day for 3 days. Like $200 to dig a Olympic-sized swimming pool by hand. And he tried to do it with a machine, and it actually wound up costing more. Or my Malawi company has 16 acres of soybeans. I asked them, how do you harvest them? Because there's actually on video. You can see a video of me standing next to 16 acres of soybeans. And he just looked at me like I was nuts. He said, well, you go to one of the villages nearby and you hire 100 farmers. People, yeah, you hire 100 farmers, you pay them $2 each. And by the end of the day, it's harvested. Yeah.
Yep. Different world.
Yeah. You don't buy forklifts, you hire people to pick up stuff and move it. Yep.
Well,
this is actually really good, because you provide income for the local villagers. Yeah.
Yeah. Unemployment's through the roof. You might as well solve the problems with people.
Yes.
Cool. So we have many other workshops that are scheduled for the summer. So we'll be doing Tuesday nights and Thursday noons all through the summer. Entrepreneurs doing pitch practice, Angel 101, discussions of investors and how they got into investing. All of that will end up on the meetup group that got you here. We put the recordings for this on our YouTube channel. Let me make sure that I post that for you, so that you can go look at these. I think there's some really good workshops in there, including the why you should be doing revenue redemption from Luni Libs is in there as one of the recordings. So please go and sign up as a subscriber to the YouTube channel. Come to our other workshops. We will be running the final of the Transatlantic Angel Conference on July 7th. I'll be posting that shortly. We'll be running Seattle Angel Conference 22 starting in August, and the Transatlantic #2 in September, and then the APIS Health Angels in February of 2023. If you have angel investing questions or local resource questions, glad to be helpful.
Yeah,
Thanks
thanks
for
everyone
coming.
for coming.
Thank you so very much, Luni.